So did everybody get
Yeah, I already handed them out, only if there's some stragglers.
Okay.
I haven't tested them up.
Great, thanks. Okay, so a couple of logistic things. First, the TA sessions have been set, and I assume you've received the email about that. The first one is tomorrow. Sam is going to be running it after tomorrow's class in this room. The Monday TA session, the Danielle session, is going to be in room 807, but that begins next week since I think it's at 1:30, and so we'd have to have a way back machine in order to get everybody there.
Just to clarify, the one for tomorrow is not yet in this room. It wasn't available. You'll get the email momentarily. But
all right.
The one next door, I think. It's one to be. Most of the others will be in this room.
Okay, all right. So, but the point is the TA session will be held. Now, beginning tomorrow, we're going to do some finance material. For those, how many have taken what could be called a finance course, a corp fin course? How many? And how many have in college had a finance type course? So what are the total hands of those who've had a finance type course? Okay, and how many have not? Maybe I should get that. Okay, so we have a nice even split. That makes it easy to do this stuff. All right, so I do 2 weeks of this, which is, for those who've had a finance course, you'll appreciate the ways that we're doing some hand waving over important things and going rather fast. And part of that is so you won't think it's tiresome. But the point is, for those who haven't had a finance course, my goal is to give you the intuitions associated with some of the ideas that we're going to be discussing, not to put you in a position to run a spreadsheet. That's some other folks at the school here. But there's some pretty deep ideas embedded in some of the finance stuff that I think every M&A lawyer, indeed every lawyer, really needs to have, right? I mean, a lawyer who doesn't have a really good idea about present value and the difference between getting money today as opposed to money in a year is not going to be able to do very well for clients. Think about a divorce proceeding in which your client's going to receive alimony or some other payment, right? How much is he or she going to receive? Well, they're periodic payments, but how much is that in some way you can use in negotiations? And so some of that machinery we're going to be discussing. We're going to be discussing the ideas of risk and return, which are critically important to understanding how you should run your personal investments. So, you know, that's well worth the price of admission. And a few other very important ideas, which again are the goal of which is to give you some of the intuitions which will help you manage better the things that lawyers do on behalf of clients, and indeed the things that lawyers do in managing their own affairs and those of those who look to them, because you're supposed to be sage and smart, who look to you for advice, family and otherwise. It would help. I think, you know, I put the materials all online, haven't really printed them out for the most part, for the sake of economy. But I think you should print out the materials and bring them, because we'll be referring to pages in the materials and tables, and you know, it's important to be able to flip back and forth. And I'm not sure that if you have it on a computer or the iPad, it'll work as well. And also, there are a couple tables the present value table, the annuity table, and we're going to do some exercises with those tomorrow, and so just having those in front of you, I think, would be very valuable. So it's not a lot to print out, but it would be good to bring it in, I think. Okay, so that's the logistics. I want to call your attention to some M&A developments that were in the Wall Street Journal, which I've said in that respect is well worth reading. So it seems that among the impact of the tax bill and maybe a few other things, M&A activity in the pharma area has perked up. And indeed, there were 2 deals announced recently, well, in the last couple days, really. One is Celgene, which is a pharma firm that does cancer research, buying another specialist firm in that field, Juno Therapeutics, $9 billion deal. The premium is a 90% premium over the unaffected market price for Juno, which is kind of stunning, right? 90%. That's practically doubling your money over last week's price. And what do you think the market's reaction was to that deal as reflected in the Celgene stock price upon the announcement of the deal? Anybody have a guess? Anybody have an idea? What would you expect? Yes. The Celgene price to go higher, the acquirer's price to go higher. No, well, the target's stock price will certainly go higher because it's the offer price is 90% over last week's closing price, so that's going to go up. But what about the Celgene price?
So that one will probably.
The mic, please.
This is a new classroom for me.
Good.
So I recall that we talked last week about when you're the acquirer, so your stock price goes down. Normally after you make a big acquisition, so I would assume that it will go down as well.
So you would expect the Celgene stock price to decline, and what would that be a signal? And what might you think that would be a signal of?
Maybe the market is showing that they paid over for that company. That's what I think.
Yeah, the fact that the Celgene stock price declined would be a reflection of a belief by the shareholders of the acquirer that the acquirer overpaid for the target. How would you... And they overpaid, and the deal consideration here was cash. So this isn't like I'm giving you my overpriced stock for your overpriced stock. This is cash going out of the strong box into the shareholders of the target. So how would you assess whether this deal overall created or destroyed value from an overall perspective?
It depends on how you're going to measure value.
I'm sorry?
No, it depends on how are we going to measure value.
Okay. Could you say a little more about that?
Well, who are we creating value for? For, let's say, for the acquirer. So what's going to be for him from this acquisition? What are the benefits from him from this acquisition? That's
imagine that you are advising the board of directors, and the CEO comes in with a proposal to buy the target stock to buy the target at 90% higher than the trading price of the target the week before, right? So what might be the questions that you encourage the directors to ask?
Well, what is the expected cash flow that they see from this acquisition? What's the growth that they're looking at? Whether the interest rate that they're looking at? I guess these are the...
Well, the interest rate, I mean, except those are finance factors. What else might you be pushing
synergy?
acquire management about, right?
So synergies, perhaps?
The synergies, but presumably the market, the shareholders of the acquirer are taking into account prospective synergies of the transaction, and they're downgrading the acquirer stock price. What else? Anybody have another thought on this dimension? About the questions that you would be advising the directors of the acquirer to ask the management team, right? That's the way to think about this, right? The directors have a fiduciary duty. The directors of the acquirer have a fiduciary duty to exercise a due care to inquire in a reasonable way to get the protections of the business judgment rule. So what might you be pushing? What kind of queries would you be pushing the directors of the acquirer to make of the acquirer management team? That's the question. Yeah.
Maybe whether they were able to gather sufficient information to support the premium that they are offering.
Sufficient information. Could you say a little more?
Like whether they obtain like accurate forecasts about the target company, whether they could do like deep due diligence, whether they could map all the risks and liabilities falling on the target company, and so on.
Okay, so this point is, one quick way to put it is, what do you, the management of the acquirer, know that the market doesn't know, right? Why do you have a higher value for target than the market has? And Eduardo's point is, we can imagine that before the deal was announced, there was a negotiation between the acquirer, between Celgene and Juno, in which the management teams discussed in great detail what Juno had to offer, its plans, the new drugs, the new research it had, the new prospective drugs, and this information, which it had not yet revealed to the market, perhaps because it's competitively sensitive, perhaps because it's a little too iffy to put in a disclosure statement that you're worried about the anti-fraud rules applying to, becomes the basis for Celgene's management thinking that the target is actually worth more than the market price of that is reflected in the current stock price, right? So you would be encouraging your clients, the board, your clients, the directors of the acquirer, to be asking management what is the information basis for their belief that Juno is worth a 90% premium over the market price of a week ago. And then the puzzle is, of course, and here we're going to stop, presumably the shareholders of the acquirer, the Celgene shareholders, are imagining that the reason that Celgene is willing to pay more than the market prices precisely because they had these pre-deal discussions, right? But nevertheless, they're not willing, the stock price doesn't reflect a belief that when it'll all come out, the deal will in some way be a good deal for the acquirer. So, anyway, all right, so the point I want to make is, I'll keep coming back to this point. Thinking about some of these market type issues, finance type issues, helps you as a lawyer appreciate the kind of questions you need to direct to your clients, the board, as they consider these matters. And so acquiring the sophistication that, the goal of the course is to push you towards is not, so you become investment bankers. Rather, it's so you become lawyers who can do a better job. Okay. Let's turn to the third of the intro days in this course, which is private ordering in M&A. So the reason I've given you the acquisition agreement and asked you to look at it in a close way is because, as you'll see in, at the firm, as it were, in practice, most of M&A is private ordering. Parties negotiate the terms of a deal. They inscribe that in the merger agreement. Some of it's boilerplate, but a lot of it's not. And if you just think of it as just boilerplate, you'll not really be doing the full job for your clients. And so part of the point of looking at a simple M&A agreement at the beginning of the course is to put in mind the idea of M&A as a private ordering matter in significant measure. And I said at the end of the Wednesday class that in considering M&A, the clauses, the points of it that relevant to that consideration were two theoretical ideas of adverse selection and moral hazard. I'll say a little bit more about what they are, and then we'll dive into the agreement. So, moral hazard is also known as hidden action. It refers to changed behavior after the fact. In the simplest way, we've hired the CEO because he or she had a track record of high energy, high focus behavior in the prior job. So we're now going to make this person the CEO of their firm. How do we control a change in behavior on his or her part to decide to spend more time sailing or golfing or reading books, reading fiction, going to movies? How do we control that change in behavior after we've made this investment or after we've made this decision to hire the person as CEO? A classic answer to the moral hazard of somebody having a job is to build in incentives. So if you condition that person's salary or compensation on achieving certain results, that will give that person incentives not to shirk on the job, to remain a hard-working type, and that is one way, a classic way to control, quote, moral hazard of the CEO is to have incentives to work diligently for the firm, to expend effort, et cetera, right? All right, so the other theoretical frame is that of adverse selection, which is hidden information. It's information that is known to one party but not the other before they enter into an agreement. The classic issue with adverse selection is the market for lemons. How many of you heard the market for lemons story about the used cars and all that? Is this familiar? And well, how many have not heard this story about used cars and lemons? All right, well, there are a few I'll refresh, right? So one way to understand the issues of adverse selection and how we attempt to control them is to look at the used car market. Classic story, right? So the dealer knows if the car is a high-quality car or a low, if the used car is a high-quality car or a low-quality car. A high-quality car will call, what, a peach? And the low-quality car will call a lemon. But the customer does not know, going into the lot, anything about the quality of the car. And let's imagine that the dealer thinks that a peach is fairly worth $10,000, but a lemon is worth only $5,000. So the dealer would value the peach at $10,000 and wouldn't sell for less than $10,000, and would be willing to sell the lemon at $5,000. You walk in the lot, you don't know whether it's a lemon or a peach, and so you figure, well, there's a 50-50 chance, assume, and let's assume for a minute that, you're not a risk-averse person. We'll discuss in a couple days what that means, but you're willing to, in a sense, offer the expected value of your draw from this pool of used cars. So you figure the average value of the used car is $750 here, $7,500. In effect, what you're doing is pulling all the lemons and the peaches, and your offer is, well, I've got a 50-50 chance of getting one or the other, so I'll offer, in effect, the average price, $7,500. Now, what then happens? The dealer who knows the quality, you're looking at this car. The dealer knows the quality, and if you've selected a peach, the dealer is going to think to him or herself, I'm losing $2,500 on this deal because I'm giving the buyer a car that's worth $10,000 that I value at $10,000 for $7,500. I'm not going to do that deal. However, if the buyer has selected a lemon and is now paying $7,500 500, you're eager to make that deal because you get a lot more over what we will call your, quote, reservation price, the price you would be willing to sell. The buyer says, wait a minute. The only car, the buyer says, I now have information. I know the dealer is not going to sell me a peach for my offer, so I must be getting a lemon. I'm not going to pay $7,500 for a lemon. And so what will happen then is in this little story, the market for lemons, the only kind of cars that can be bought and sold are lemons. Because if I offer $5,000 and it's accepted, that's a fair trade. Except the very fact that the dealer has the very fact that the dealer has accepted 5 or above shows that it's a lemon. So it's impossible for high-quality merchandise to be sold in this story because of the information asymmetry between the dealer who knows the cars and the buyer who doesn't. So the story about adverse selection is that the buyer knows that the dealer has better information, and in effect, the only car that the dealer would be willing to sell at a price that the buyer would be willing to pay will be a lemon. And so, in effect, the market for lemons is that the only goods that can be sold, bought and sold, are the bad ones. So, the question is, and this is sort of a key issue in the contracts course. How do we separate the lemons from the peaches? How does the dealer separate the lemons from the peaches? How does that work? How does the dealer do it? Kevin, what do you think? Mike.
Yeah. What do you mean by separate? I'm a little bit confused as to...
How does the dealer try to help the buyer appreciate the differences between the peaches and the lemons?
He could offer a warranty on the car, and he would be willing to give a warranty to a peach because he would be unlikely to have to pay it, whereas if he gives it on the lemon, he's likely to have to pay it, so he would be less likely to do
a warranty. And why is and so say more why the warranty is able to do that work?
Because you'll only offer a warranty that you're unlikely to have to pay out on, because it's a guarantee to, like, for example, pay all maintenance for.
Okay, right. So the I want to slightly. I mean, that's analytically that is totally correct. The way you'll sometimes see it described is what makes the warranty or whatever else the dealer does a credible signal. That's the word, a credible signal of quality, of high quality. It's because the signal is costly. So in other words, when the dealer says, this is a peach, why should I believe him or her? It's because if it is not a peach, it will be costly for the dealer. It'll impose costs on the dealer And so because it is costly to claim that a car is a peach when it is not, I can credibly believe, or the dealer has credibly shown, signaled, that one car is a peach and one car is a lemon. The warranty is costly in the case of a lemon because you're going to need to do a lot of work. It is not costly in the case of a peach because the peach is going to run just fine. My willingness to give a warranty for this car is a credible signal that it is a peach, precisely because I know that if it is a lemon instead, the dealer is not going to make the $5,000 of profit, but is rather going to have to be paying big warranty bills. And so therefore, auto dealers give warranties for cars that they think are peaches, and the point is, I'm willing to pay $10,000 for a peach. I'm willing to pay the $10,000, and the market for high-quality used cars can exist. In other words, the dealer's willingness to give what we'll call a costly signal of quality makes it possible for a complete market in used cars to exist. So that's the classic story. And Akerlof, who came up with this story, won a Nobel Prize for that story. He didn't even use math, right? It was just the insight as to how information asymmetries, that's the technical term you'll see used, can really screw up a market, and how parties can, by private ordering, overcome those information asymmetries and make markets work. And so the reason for the build-up, and we'll get to it when we come to the M&A agreement, is, as you can imagine, as between, let's go back to the Celgene and Juno example that Eduardo said there had been a prior course of dealing between the Celgene management team and the Juno management team, in which Juno made certain claims about its science, about its future drugs, et cetera, et cetera. How does Celgene know if all the claims made by the Juno management team can be believed? I mean, the Juno management team, they're sitting there with stock and stock options on which they're about to get a huge payout, right? 90% premium over last week's price. They have tremendous incentives to puff, if not to outright lie, right? So, if we were to look in the merger agreement between those two parties, you will see lots of reps and warranties, the point of which is to make it costly to the Juno management team to have not been honest about the claims it is making on behalf of the Juno firm. There is presumably the very fact. So what do we know? What do we know? We know that on the basis of the information that was known in the marketplace, Juno last week was trading $100 a share. The offer price, I mean, the figures are not exactly right, but the offer price is $190 a share. There was presumably a lot of information that Juno management knew and the market didn't, a huge amount of information asymmetry there. The negotiations were all about information sharing, and what makes it credible that Juno is a peach, not a lemon, presumably are the reps and warranties contained in the merger agreement, which will make it costly for the Juno management team to have been less than honest about what its science and future drugs might be. All right, and so notice how without the reps and the warranties here, which let Juno management credibly signal that Juno was a high-quality biotech firm, the deal could not have happened. Because if Celgene had offered the market price, $100 a share, and Juno management had information that said the firm was worth $190 a share, they would have been like the automobile dealer who, having received, a lemon's bid, is not going to sell a peach. And so the claim that to be made here is that what's valuable about some of the tedious way parties do the reps and warranties, and we're going to discuss them in these circumstances, is precisely because they try to control the information asymmetries that make it possible for these deals to occur. Okay, all right, so let's look at so is Zoe Wu. Zoe, so what was the consideration paid? This is a private deal, a public acquirer buying a private target. What was the consideration that the acquirer was going to pay? Mike, please. Yeah. Okay. Let's see. Ryan, so what was the consideration?
I believe it was shares in the acquired firm.
Shares in the acquirer. All right. That is true. And let's look right at the agreement. Where does it say? What is the provision that leads you to think that it was that's the basis for the deal? Where would you look?
The terms of the merger?
Terms of the merger. Okay, great. So, how much acquirer stock was the shareholder of Target going to receive?
Equal to the amount of the Target's net worth divided by the acquirer's book value per share, plus $15,000 that I think are held in escrow for a while.
15,000.
Or shares, rather, that are held in escrow for a while.
Okay, so the consideration was going to be shares in acquirer determined by this formula. Target net worth divided by acquirer net worth on a per share basis plus 15,000 acquirer shares. All right. So, how was target net worth going to be determined? What is target's net worth? I mean, as an overall idea.
The value of their equity, correct?
Well, that's not a defined term. Right, all right. So the net worth is equity, but shareholder equity. But how do you determine that?
A valuation at the target company's cost, I believe.
Valuation,
Just a valuation at the expense of the target company. That's just an audit.
The valuation of
the target company through.
I mean, but how would you do that? How many have had accounting for lawyers or any other accounting course? How many have not had an accounting course? Like, how many have not had any tax course? And how many of those who haven't had a tax course or an accounting course are 3Ls? I suspect there are more, but and you're brave. Anyway, all right. So some of this accounting stuff is valuable. I mean, I would say essential. But you can pick it up. So let's look at a balance sheet. Balance sheet it's divided typically into two halves, assets and liabilities, and then shareholder equity, or maybe it's some definitions, maybe net worth. And they're different. As we'll discuss, there are different ways to value a firm. When you look at a firm's assets, there are the concrete assets of the firm, the value of the computers, plant, equipment in the plant, maybe the value of its patents. These are the assets of the firm, and any business. I mean, if you think about your own personal life, I mean, you own certain things, and those are your assets. And then there are the liabilities. They're the debts the firm took out to buy the assets and to fund other elements of its business. And when you subtract the value of the assets, when you subtract the liabilities, the value of the liabilities from the value of the assets, you end up with net worth. Now, that's a simple and simplistic statement of the whole thing for those who've had accounting would know, because the valuation of assets is subject to assorted conventions, which often distinguish between the quote book value of an asset and the fair market value of the asset. And liabilities also can have sort of a deviation from the book value of them and the fair market value of the liabilities. But so in effect, how is that resolved here? So basically, the way the parties have resolved it, because it might be that the management of the acquirer would have a different view as to how to value these assets, they bring in an accountant. They bring in a neutral party to make the determination of, in effect, what the net worth of the target is. It's supposed to measure the value of these assets, subtract the value of the liabilities, and you'll end up with an agreed upon net worth of target. Now, let me just drop a footnote here, an important one, because think about the value of in effect, we've computed the net worth of the book value of target by taking the value of the assets minus the liabilities, and that's a number. It comes right off the balance sheet. But and we'll see this later on, is that really the value of a business, right? Because if you just, I mean, presumably a business is more than just a pile of assets. The question is, what income is generated by the management team's ability to sort of use this pile of assets, right? The genius of good management is not just collecting a pile of assets for their own sake, but rather to begin to generate an income stream out of them. And perhaps a better value, a better way to value the business, as we will see, as we'll follow from tomorrow's discussion, is the present value of the ongoing earning stream generated by the business. Maybe that's a better way to value this business. The parties have chosen otherwise. They're going to use a comparison of the net worth of the target and a term derived from the net worth of the acquirer as the basis for the determination of consideration, right? So, Brian, imagine the negotiations that would have resulted in that determination. Target management says, wait a minute, it's silly to look at us as a going concern. Sorry, it's just a pile of assets to value us on that basis. You ought to look at the earning stream. And the acquirer is wanting to use its stock, is to want to in effect. So there's a target says earning stream. Acquirer says stock equal to net worth, right? In other words, assume the target's worth $10 million. We'll give you stock equal to $10 million, right? Is that the deal they struck?
Sorry, I'm confused on the deal.
What they struck is a deal that used, in effect, the net worth of target as the baseline. But they also used the net worth of acquirer as the baseline, right? Because the the number of acquirer shares was the based on the per share net worth of acquirer shares mapped onto the net worth of Target. I don't mean to be abstruse here, but so this is the thought, right? So basically, when acquirer says, let's value you on the, you're not a public firm. We don't know what your income stream is worth, right? You don't have a stock price. So let's value you on the basis of your net worth, the $10 million, and then we will give you the number of shares, acquire shares, equal to $10 million. That's not the deal they struck. And you can imagine the pushback from the lawyer for Target going, wait a minute, you're not letting me value my business on a going concern basis. You're insisting on, in effect, a net worth figure. So if we're going to play fair, we have to use a net worth figure for your business. And so, in effect, I don't care what your stock price is. I care what your net worth is, because you're making me live with net worth, which is maybe a crazy way to value a business. But then if it's good for the, you know, if it's sauce for the goose, it's good for the gander, right? I mean, right? You see the point here is that in the case of a public firm, you've got a market measure of its going concern value as reflected in the stock price. In the case of a private firm, you don't. But in this particular negotiation, in effect, the net worth figure was not converted into acquirer stock, as you might think. Rather, the parties, presumably the shareholder for Target, said, we're going to use your net worth as the basis for comparing our two firms. If we're going to use assets for me, we're going to use assets and liabilities for you. Right? So, and it's not obvious that this is the way to, there is no correct way, right? But I'm just saying, if you think about the kind of the strangeness here of why they should use the net worth of acquirer when there's a public stock price as the basis for giving the shareholder of Target his or her consideration, you might think it goes in this, this claim about parity. All right, so plus 15,000 shares. So before we go there, let me just to give you a numerical example so you'll see how the formula is supposed to work. So so assume the acquirer is worth $1 billion, and it has 10 million shares. So the acquirer's, on a per share basis, its book value is $100 a share. The acquirer's book value is $1 billion. It has 10 million shares outstanding, and so if you just do the simple division, you'll see its net worth, its book value is $100 a share. All right. So that we know. We now go to Target and we hire the accountant, and let's assume that the accountant decides that the Target's book value is $10 million. So how many shares does Target get? It's the book value of Target, and this is just, you know, the words here. I'm just reading you, this is the formula in the agreement. The book value of Target is the $10 million divided by the book value per share of the acquirer, which is $100. So basically, we see that so there's 10,000. No, it's what have I? 100,000 shares. What have we got? Right, 100,000 shares. I think. Yeah, 100,000 shares. So the Target gets 100,000 shares plus 15,000 shares are put in escrow. Again, the net worth of the Target is divided by the net worth per share of the acquirer. It's 100,000 shares plus the 15,000 shares. Okay. So, Ryan, what are the 15,000 shares all about?
Based upon the conditions where they can get them back early, it appears to be to maybe curb some of the moral hazard concerns by encouraging performance of the thing that they're purchasing.
All right, so what language, I mean, what provisions are you pointing us to? What elements of the agreement are you pointing us to?
Like B2, A, B, C, and D.
Right, so this is 2B 1 or 2B2A. This is on page C4. What about, and this is A and B, so what about, I mean, A, B, and C make you think that this is to control moral hazard. Tell me a story about how the holdback of the 15,000 shares could be explained through a moral hazard story.
So it's based upon just the Target's operations, even though they have since been combined with the acquirer. And I suppose to incentivize managers from the Target or whatever inputs they have to perform as they had in the past, that they would release some of these shares from escrow upon them exceeding past sales.
All right, so yeah, I mean, assume you have. Let's just limit it to the CEO. The CEO is now selling her firm for a lot of money. What's going to keep her putting in those 80-hour weeks? It's the thought that, in effect, there is performance-based pay. If she can deliver a 15% growth in net sales on a year-on-year basis, which is, a nice target to achieve. 15% year growth, 15% net sales growth year on year. For each of the 3 years, she'll get an additional 5,000 shares of acquirer stock. So that controls moral hazard. Before the firm was sold, she was already, she was really a hard charger. That's why the firm was successful. She's going to remain with the firm for a period of time after the sale. And the point of this, this arrangement is to give her incentives to remain fully engaged. So that's an effort to control moral hazard. All right? is there possibly an adverse selection story, which may be a different story altogether?
Perhaps if based upon information that were given in negotiations, they were expecting an increase in sales, this kind of hedges against the possibility of that not coming to fruition.
Right. The negotiations said, the CEO says, you know, this firm is really going to grow. I know that we're selling the firm on the basis of net worth, but really the value in this firm is its future growth. How do you monetize that, right? How do you overcome the difference in value that the two parties have based on their beliefs about the future? Or how do you know that the CEO is telling you, you know, the God-honest truth that she believes that this business is really going to be growing as fast as it was, if not faster, than over the last X years? And a way to do it is to have a payment structure that shares are paid out of the escrow if that high rate of growth is achieved, right? So it overcomes an adverse selection issue. It overcomes an information disparity because the buyer doesn't know, in fact, what the CEO believes truly to be the growth rate of the firm. It is costly for the CEO to take payment in the forms of future stock if he or she doesn't actually believe that's the growth rate. So, in effect, here's an adverse selection story about credible, how do you make my belief, my honest belief that this firm is really going to grow, credible. And one way perhaps to distinguish between the two stories, they both seem to work, if the CEO leaves the firm upon the signing, then we would know for sure that this is an adverse selection story, right? Because the CEO is no longer going to be there to supply effort, and so this is really, and so she gets payout only if the firm achieves the growth that she thinks that it will, in fact, truly achieve. All right. What's a third story that would account for the 15,000? What's a third story, Ryan, that would account for the 15,000 extra shares that doesn't depend on either moral hazard or adverse selection?
I'm not sure.
Anybody have an idea? Yeah.
It could be dispute over the valuation if the target believes that their the net worth value underestimates how much they're worth, then putting an extra 15,000 as potential payment. Basically, if the target says we're worth more because of this growth expectation, but the acquirer isn't willing to value them on the basis of that growth, then putting in this extra 15,000 that they get if that growth comes true is kind of a way to make them happier.
Yeah, I mean, it might be that there's just kind of a difference of view about, you know, the state of the world, right? Will we be living in a high growth versus a low growth environment? Will people want the shoes I'm making or not, right? There's just kind of radical uncertainty about it, and it's not based on the relative information the parties have. It can just be about differences of view that they have about future states of the world, and in effect, one way to think about the 15,000 shares might be that if the circumstances, if we're in a boom economy or in an economy in which, you know, my shoes are now fashion statements, you know, then I'll have the high sales growth, and I should get some share of the realization of the positive state. Right, it's a way to split the difference about expectations about the future, which are separate from anything I know and separate from the degree of effort that I'm going to bring. It's just, you know, there's uncertainty, and this is the way that we divide the payoffs from the realization of the good versus the bad state. And you know, all three of these things are plausible accounts of what's really going on, and you know, you'd have to be in the middle of the negotiations to understand what really was motivating the parties here. But part of what, you know, we're trying to do is to think about what the possible. I mean, often what lawyers do when they look at an agreement that they themselves were not negotiating, or maybe this is not the provision of it that they negotiated, is trying to read these words or the provisions and to understand what the parties were thinking, right? To decode an agreement, to read it, to appreciate what the negotiating positions of the parties were and why they got to where they got. And that was a little bit of what we were doing when we were discussing why they cast the consideration in terms of net worth per share for both the acquirer and target, right? And it's what lawyers do all the time, and it's very difficult because an agreement like this does not come with a sort of a guide of these were my intentions, right? The agreement is the agreement, and part of what the work is to understand what the parties were trying to do when they wrote, when they structured it in this way. All right, so let's look at the reps and the warranties, which is Roman 3. So have a look at 9. This is on page C7. So there's something we see very common here. It's sort of like, it's the second sentence. Except as noted on Schedule A, Target has got good title to everything it says it owns. And so this is commonly the way a merger agreement will be written. A lot, or it'll be, or you'll see. I mean, they're schedules that have backup. So there's a rep. I own everything I say I own, except as I list otherwise, or I'm not being sued, except for the litigations identified in Schedule X, right? And so commonly agreements will have, on the face of them, boilerplate statements of what I own or what I'm exposed to, what I'm not being sued for, or whatever. And then there will be schedules which have the carve-outs to the flat statements in the agreements. And there'll be schedules that list all the key agreements you have with counterparties. So part of what the due diligence that lawyers do after an agreement like this is signed is in effect to fill out the schedules, because the parties will say I own everything I say I own except as listed in Schedule A. And then part of what lawyers will do is to make sure that Schedule A, which lists all the exceptions, is complete, because you don't want, after the fact, to be found out to have misstated in a material way ownership claims that are not viable. Look on page, look for 19. So this is what is commonly known as a material adverse change clause of a particular type. So in effect, the way a merger agreement is set up is it's signed on day one. Typically, there is a period of due diligence in which the buyer's attorneys have a right to come in and examine all of the material elements of the target to make sure that the condition of the target accords with the reps in the merger agreement, at least in so far as can be determined on inspection. Also, in the case of a public firm, there is necessarily a period between the signing of the agreement and the so-called the closing of the agreement, when the merger becomes effective, because for a public target, the shareholders who get to vote need time to consider the proxy statement that will be filed under the federal securities law. So there will be many days between the signing and the closing. The concern is during that period, there has been a material adverse event, material adverse change in the condition of the business of target, which, depending on the circumstances, may give the acquirer the right to walk away from the deal. And so typically in one of the hotly debated clauses in a public firm M&A agreement is the terms of the material adverse change clause. So, all right. So, final point, and that is the condition to the acquire and subs need to close. The targets need to close. This is Romans 6, Romans 7, pages C17 and C20. Again, the effect of the due diligence is to give the parties a full assessment, particularly of the target, particularly to give the acquirer the right for a full assessment of the target's business. Is it truly as was claimed in the midst of negotiations? Have circumstances changed? Has the Justice Department filed an antitrust suit? Has there been a higher bid for target? All these things may condition the acquirer's duty to close, the subsidiary's duty to close, the target's duty to close the deal, finally to finish the deal. We'll be discussing that a little bit later, but even in a simple agreement like this between that of an acquirer and a private firm, the full array, the full set of clauses is here available. Even the most sophisticated M&A deal in the world will basically look similar to this in many respects. That's what's sort of amazing. One final point before we go to see if you. So look at the reps of Target, right? So the reps of Target are extensive, and they go from page 5 to page 11. 6 pages. Reps and the warranties of acquirer are basically 3 pages. Why is there the difference? Why is there the difference? Remember, the consideration here is acquirer stock. It's not that acquirer is paying cash and cash is cash, right? Why are the reps for the target so much more detailed than those for the acquirer, even though the consideration is stock? Yeah. And Andrew?
Well, the acquirer is a public company, so they have all their information publicly disclosed.
Right. The acquirer is a public firm. It's had its 34 Act filings under the pain and penalty of the anti-fraud provisions of the securities laws. So in effect, the shareholders of Target who are now receiving acquirer stock have got a lot more security about the true value of acquirer because of the public filings associated with being a public firm. The shareholders of acquirer are, they're buying, I don't want to say a pig in the poke, but, they're taking a much bigger risk on the quality of Target's assets and business. And so, therefore, you would expect there to be a lot more reps and disclosure, warranties, duties, etc., flowing from Target to acquirer than the other way around. All right, so good. We will stop here, and then tomorrow we will turn to a little bit of finance, some discussion of present value. Look at I think there are questions at the end of, Q&A at the end of Chapter 2 in the original version that I've asked you to solve. We'll do some of those in class. There's going to be a TA session tomorrow, right following class, which will be perhaps good for those who are not immediately getting this. We'll begin a little bit discussion tomorrow about risk and return as well. See you then. Hi, how are you?
I came last week to ask if you could supervise my writing project.
Oh, right. And did you?
Yeah.
Did you sketch out what you wanted to write about?
Yes, I did. Over the weekend I did. So I kind of have a 2-3 page outline. I was
Okay.
wondering if you had time, when you would be available this week.